Hello and welcome to the day ahead. It is Wednesday, April 20th. I'm Andrew Gagan. Let's get straight to it, and the rally resumed on Wall Street overnight as big tech reversed course and a raft of big names beat the street on first quarter earnings, which helped offset investors' woes over higher yields and a plunge in oil prices. The mega caps, Microsoft, Apple and Amazon, were all higher as Treasury yields continue to surge, with the 10-year TIPS yields turning positive for the first time since the beginning of the pandemic in 2020. Well, energy, no surprise, the biggest drag after oil prices tumbled more than 5%, and the IMF downgraded its growth forecast for the global economy, warning of higher inflation. Stock specific, earnings took centre stage. Netflix shares were hammered in after-hours trade, down more than 20%, erasing $30 billion in market value, as subscriber numbers fell for the first time in a decade and revenue missed the mark. Looking ahead, the contraction is expected to continue, with the company forecasting another drop in subscribers in the second quarter of around 2 million. The poor results pummeled other streaming-related stocks, with Roku, Walt Disney and Warner Brothers, Discovery, Paramount and Spotify all down significantly as analysts rethink growth forecasts for the streaming industry. In stark contrast, Johnson & Johnson shares hit a record high after its first quarter numbers beat market expectations with a 6.5% boost on the dividend. The stock, though, did come off the boil after the company lowered its outlook on external supply constraints. And finally, Twitter shares were under pressure amid reports more private equity firms were thinking about throwing their hats in the ring to take over the social media giant. Twitter hands down its first quarter numbers next week. On the macro front, well, the International Monetary Fund has slashed its global growth forecast to 3.6% for 2022, down from January's forecast of 4.4%, citing the ongoing conflict in Ukraine and warning that inflation is now a clear and present danger for many countries. In FX markets, it was all about the US dollar, the greenback scaling a 20-year peak versus the yen and its highest level against the Swiss franc since 2020. And is up above 101 for the first time in 2 years. The spike underpinned by the divergence in the path of policy between the US Federal Reserve and the Bank of Japan. Well, staying with the Fed, a more dovish tone from policymakers after St. Louis Fed President Bullard, his comments for a 3.5% neutral rate by the end of this year. Chicago Federal Reserve Bank President Charles Evans, who isn't a voter this year, said he's comfortable with a round of rate hikes this year that includes 2 50 basis point increases and reaches a neutral setting by the year end. Atlanta Fed President Raphael Bostic, who has been somewhat of a dove in recent commentary, moved to calm some fears of a more than 75 basis point hike, which was suggested by St. Louis President James Bullard, saying while any action is possible, that big move is not on the radar. The euro recovered some lost ground. Sterling was lower, while the Aussie dollar has come off the boil after testing the 74 US cent handle on the back of the RBA minutes yesterday. So Wall Street's positive sentiment is set to push the Australian share market higher this morning. SPI futures currently up around 0.6%. So those energy prices did fall overnight after the IMF released its downgraded economic growth forecast. However, global supplies remain tight, with the Strategic Petroleum Reserves reporting that emergency stocks fell by 4.7 million barrels at the beginning of the week. The price of Brent down more than 5% to $102 a barrel. Natural gas futures fell 8.5%. Metals were mixed overnight, copper falling 2%, gold down more than 1.5% to leave it near $1,948 an ounce. Looking ahead, Washington H-Sol Pats trades ex-dividend today, while markets will continue to focus on the miners. Iron ore tanking in the Asian session yesterday after China vowed to cut steel output in 2022, adding to concerns over demand prospects. This at the region of Shenzhen implements yet another round of COVID lockdowns in 4 districts for at least 3 days, as Beijing continues to aim for COVID zero. And that is your day ahead. See you again tomorrow.